Hello and welcome to NPT Banking. My initials are NPT and I talk about banking. That is why the name of this channel, NPT Banking. Hello friends, today we shall be discussing the recent trends which are going on and which has made me confused. I'm totally confused. This is not a critic on anyone or any organization or any institution, but I am hoping that you, the viewers of this clip, may reduce my confusion a bit. Now, what is this confusion? It is this confusion. So much penalty imposed by RBI on all the banks, so many banks. Ever since I have become a student, at least even since school, when I was reading the newspapers, I had never seen penalty after penalty or even a single penalty imposed on a bank despite the scandal. Lot of scandals came in, but no penalty. And if you see the trend, it is not that they are just cooperative banks or just nationalized banks or just private sector banks or only Indian banks. Look at it. I mean, Credit Suisse is there, Indian Bank is there, IndusInd Bank, private sector banks are there, Punjab and Sindh Bank is there. And we have seen cooperative banks also there. So, what is going on? I'm confused. Do you mean to tell me that all this time, all the banks were able to perform as per each and every circular of the RBI? The RBI circulars are numerous. Today we have the facility of internet and a website from which we can read. Earlier the circulars used to come on a paper that was hardly readable, and the people who could not read either English or Hindi used to just keep it. I have seen with my own eyes. They used to just keep it in a shelf and wait for somebody to come and translate it. By the time a lot of water has flown under the bridge. But today it is available. But the kind of circulars and number of circulars which have come, do you think it is possible for any bank to take a corner circular and also do it? If you look at the news items are very straight that the RBI found out that there is some discrepancy, and as per the provisions of so and so section, they have imposed a penalty. Now, those penalties, when I am just referring to as a reader of the news, it's very difficult for me to find out. I have to go through it with a microscope to find out whether it is a serious error or a serious notification done by the Reserve Bank of India inspectors. For example, in a cooperative bank, they said that amount was lent to the director, which we know it's a sacrosanct thing which you should not have done. So that is serious. But I am not aware whether the other things are serious. Now look at this one case of Axis Bank, and that will be the topic of our discussion in this clip. Non-compliance of provision of KYC norms. Ask anybody who has opened an account with Axis Bank, he feels like falling at their feet or even committing suicide, because the KYC norms which they follow are so strict at the time of account opening that you feel sorry you have chosen to open an account in that bank. But they claim that this is requirement of RBI. So if they are doing such a strict compliance, where is the question of KYC norm flaunted? Therefore, I had to dig in through the newspaper reports of many newspapers and find out one extra sentence that gave me a lead to another extra sentence somewhere else, and together I had to piece this picture, and let us see what the picture is and whether other banks can ensure that they do not fall under the penal provisions for this same very purpose. Now, this is a common paragraph we see. The fine was imposed by the bank on a scrutiny. But here this is on the backdrop of a fraud and related transaction which are submitted to the bank regulator. So, a fraud, when it occurs, you have to report to the regulator, and therefore, in this report which was duly done by the bank, they were able to study that there were some transactions which came to their notice, and that is what they were saying is that the bank failed to monitor or carry out ongoing diligence, due diligence. This is not at the time of account opening, this is ongoing due diligence to ensure that the transactions were consistent with its knowledge about the customer business and risk profile. Assuming this is a cash credit account, because in case of a loan, the loan amount is paid to the supplier directly, and therefore the bank is aware of the end use of the amount which is lent by it. In cash credit, a checkbook is given, account is opened, the sanction terms are, amount is there, and the borrower is free to utilize it for his business working capital. Now what happens is that a review is done on an annual basis, and concurrent auditors and inspectors visit the unit to ensure that the end use is as per the terms of sanction. Therefore, in between these periods, if anything happens, the bank is not aware because you have a centralized clearing. Earlier, the checks used to come to the branch manager used to sign or look at them and then approve of them, and then come to know what is going on from which cash credit account and whether it is as per the business, it is consistent with the business that he knows about the customer. The centralized clearing is not aware whether the purchase of petrol tankers is consistent with the business of a builder, because they don't look at the name, they are not aware. Yet this is what the RBI has said, that it is not consistent with the transactions with the business of the borrower. So in order to ensure consistency, they have recommended that a loan review function should be independently seen by an independent loan review group. Now you have this kind of a new committee which is firstly mentioned over here, which is non-existing earlier. When we were students of banking, or all who are students of banking, these are the type of risks which are mentioned. I have attached in the below the clip this study material of a student of banking. These are the risks. None of these risks are what is mentioned by the Reserve Bank of India for the Axis Bank. At the most, by stretching a definition, number 7, operational risk, you may put into that, but the definition for a student, operational risk, does not cover this until this date. Now there is a circular, I am not aware of the number of the circular, but a printout is also, a PDF copy is given below, which has originated from Reserve Bank of India. Therefore, we can presume that this is what the communication is. In the para number is written over here, 3.1.5. The credit risk management process should be articulated in the loan policy. Loan policy, we are aware, is a policy which has been developed and exists for years together, and it has been amended. It normally gets amended year to year, and it is, all policies have to be approved by the board. So now each bank should constitute a high-level credit policy committee called the Credit Risk Management or Credit Control Committee. So just a renaming of an existing committee possibly is mentioned over here. But concurrently, it should also set up a credit risk management department, which should be independent of the credit administration department. Please note here that we are talking about a specialized audit of credit in process here. So this is sort of a concurrent audit which is specialized process audit of credit risk management. Now in that process, they are not going to only oversee the transactions in the account, but a whole lot of gamut, which possibly is physically, in my opinion, very difficult to achieve without a very intelligent software support. We will come to that now. Para 3.2.2 mentions something like prudential limits. Now prudential limits, when the NPA norms first came out, I thought wrongly that they were going to tell me various stages of normal account before it became sick, but unfortunately it gave only one step of a normal account and later on all steps of sickness. So now possibly let me see whether it meets my dream of prudential limit by early warning. But here they are giving us only a guidance, because each and every borrower, you cannot have a borrower on the agriculture sector to be weighed on the same parameters as for a car manufacturer. So you have to define, here they say debt equity profitability ratios, single or group borrower limits. These were already there in the good banks and we were seeing that as auditors, and substantial exposure to single borrowers enjoying credit facilities exceeding the threshold limit. These substantial exposure limits will also include the consortium borrowers and the bank's maximum exposure limit to industry, sector, etc., which is there, but it should be strictly followed and should be supervised. Appreciate that. And the maturity profile of the loan book. Otherwise, you will see that in 1 or 2 years, all the loans are due and you have very good borrowers and they've all paid back and suddenly you got no advances. This is obviously a hypothetical situation, but the maturity profile of the loan book has to be seen and the bankers have a great balancing to do over there. 3.2.3 paragraph says risk rating. Now remember, this PDF file is there for your ready reference below. So kindly print out and you can, I am just discussing a few points, that the risk rating should be a single point indicator of the different risk factors of the counterparty, that means of the borrower, and should be drawn up in a structured manner incorporating financial analysis projections and sensitivity, industrial and management risks. Whoa, we are going into research here. Now this research is beyond a normal banking department, banking industry. It has to have a specialized knowledge of the industry, of statistics, of operational research, and of course communication to the software developer. On top of that, once you develop such a risk model, the exercise should be repeated biannually or even a shorter intervals for low quality customers, and should be de-linked from the regular renewal exercise. You will be aware that the renewal exercise of annual renewal exercise of borrowers means you have to just take a look, review the operations of the account and the document life, whether it is still alive or not, and some other factors. But risk rating was not part of it, and they say that do not mix this up with the regular renewal exercise, because for whatever reason it has to be independent of the credit management group, and this is a credit management group, not a credit audit group, which is doing the renewal exercise of the borrower on annual basis. Then blah blah, bank may use number of financial ratio, operation parameters, collateral, also qualitative aspects of management and industry characteristics on the credit worthiness of the borrowers. Oh boy, first we talk about numbers, now we talk about qualitative aspects. I remember years ago, maybe 35 years ago, a foreign representative of a foreign bank just asked for my help to introduce a particular group of companies, that is to their head office, and his first statement is Mr. So and so is well known in the industry of textiles. Now this statement really jarred me. Reputation can be created in a cocktail circuit also, and it has got nothing to bear with the performance of the company which he is controlling. So qualitative is not something which I personally like, but here RBI has mentioned that you also the qualitative aspects of management and industry characteristics. Now, do you understand the industry characteristics that steel goes through a life cycle of up and down of every 7 years, and textile goes through every 4 years, and trading goes through every year, and suddenly a pandemic and nobody has a cycle at all of life. and everybody goes down. How I wouldn't like to be in your place, that's for sure. And then of course keep in your risk rating beyond which no proposal should be entertained. Now, can you equalize in your model trading company, manufacturing company, import export company, agriculture processing? You just cannot, in my opinion. How can you have an industrial house compared with the farmer who has got a sugarcane farm which has got a period of 18 months versus a trader who has got a cycle of maybe just 7 days? He has got 18 months, he's got 7 days. Now, is 7 days better than 18 months? I would not say so, but you cannot have it. Maybe possibly you will have to have it per sector or per category of borrowers. Now that means the risk models many risk models have to be developed. If I was to apply an intelligent solution, I would do that. Now this is way beyond any financial management and deep into financial research. Now to help the banks, they say that you classify the off-sheet balance sheet exposures. Here I don't know whether to laugh or to cry. They say it should be full risk for standby letters of credit, that is the letters of comfort which we know Punjab National Bank has given for the diamond industry, and therefore nobody does it now. Money guarantees, etc. Medium risk, which are not credit substitutes and do not support existing financial obligations, bid bond, letters of credit, indemnities and warranties. How letter of credit cannot be full risk, I would question that. And then low risk reverse repos, currency swaps, option futures, etc. because things are just tied up over there. Appreciate that. So now by giving the banks leeway to develop a risk model, and now they are saying that in the risk model, if you have this, we are telling you this is full risk, this is medium risk, this is low risk. This is the high comfort level they are giving to the banks. In sum total, you cannot monitor the transactions of every account. Just imagine you have 10 lakh accounts to monitor just for cash credit. How many people will you require to see what checks are being issued, where the source of income is coming from? How you will see that and how long will it take? So in my opinion, the only thing that is hinted over here is you require a software. Now this software has to be very, very intelligently developed. The system designer, which I find a position which is not there in the software industry today, I don't know, maybe to save money or not. A system designer should have knowledge of the banking sector, the industry and the operation sector. What I'm saying is the research team should be there, and they should have a conversation at a level that can be understood by the programming industry. Then only in that rare event of IIT level based in research with a software of a very high company, where there will be such a rare match, then only the intelligent software will come, and only then will this risk be secured or managed or reduced. Until then, I am afraid every bank has to face this penalty. And when I was a student, I was told that the central bank of any country is the last resort. It's a guide, friend and philosopher. Here it looks more like a penalizer, a very strict teacher, etc. So therefore, I am very sorry, I am still confused. If any of you can reduce my confusion, I shall be very happy, because I am losing sleep for the sake of the banking industry till now. Thanks a lot. Please subscribe and stay tuned for more such things for discussion.